Welcome to another video. The topic of this one will be volatility trading. And with options. Okay, with options. So here's the deal on this. We'll talk about calls. Calls have prices that are dependent upon the stock price, the strike price, the remaining time to expiration, expected volatility of the underlying stock, and risk-free rate. Okay, so the value of the call is a function of those things. We're now going to talk about trading options when one believes that the volatility implied in the option's price is inappropriate, either causing the option price to be too high or too low. Okay, and if you do that, you're volatility trading. Keep in mind, volatility trading has nothing to do with movement of stock price. You're not trying to predict whether the stock price is going to rise or fall or stay the same when you volatility trade. You're basically saying that the options price is wrong because the volatility premium embedded in the time value of the options price is incorrect. It's a gutsy move. You're saying you're right and the market's wrong. So let's see if we can come to understand this. Let's say there's a call option with a price, let's say a call option, doesn't matter what its strike price is or anything like that. So some call option that currently has a price equal to, on a per share basis, $3. And you think, what you think the call, this is the market price, but your expected value of the call, so your expected value of the call right now, okay, is $270, okay? And the reason you think that it should be $270, not $3, is because you think the volatility premium related to expected volatility embedded in that price is too high. So now think about it. If all you did was write the call, then you'd be left with this, right? And I've spoken many times about how scary that is. The scariest thing in finance is stock price goes higher, your losses grow and grow and grow and grow. Okay, remember, this is profit as a function of stock price at option expiration. It's option expiration because you see straight lines with a band. That's just a bit of review. Okay, so you don't want to just do this. Well, what could you do? Because, you think stock price is going to fall, so you want to short the call. Well, here's the deal on this. What people can do is create what are known as delta neutral portfolios, okay? And we'll keep it small. We'll just talk about this one stock now. Okay, so let's say the call option that we're talking about is, let's say it has a delta of 0.6, okay? Delta equals 0.6. Remember, delta is partial C, partial S. The first partial derivative of call option price with respect to stock prices. It shows the change in the call price associated with the change in the stock price for infinitesimally small changes in the stock price. Okay? And you'll also remember, I'll tell you this right off the bat, that if we look at the relationship between, say, call delta and put delta, right, as a function of stock price, that we get lines or charts that look like this. And that's for calls. And then for puts, it's going to look like this. And you may remember that these borders are 1 and -1. And this is 0. These are from earlier videos. And so this shows the relationship between delta and stock price. Everything else is held constant. This assumes there's some remaining life in the option, etc. You may remember, I'll draw a little picture here, that let's just talk about calls. If you have two, call delta as a function of stock price. If you have two lines, purple, and I'll make this one orange, that kind of look like this. They both have that same interesting shape, and again, we're approaching 1, and here's 0. Remember, call deltas are between 0 and 1 exclusive, and one of these has the shorter life, and the one with the shorter life is, you remember, this one. Okay, so the purple line is the line that shows the relationship between call delta and stock price for the shorter life stock. You can review that in an earlier video. Okay, it's also in a spreadsheet entitled Option Worksheet, Option WS, and you can review that. Okay, but the concept of delta becomes important here, because again, our problem is this: we don't want that. We think the call is overpriced. What can we do? Well, the idea is to create a delta neutral portfolio. So let's assume we have a call that has a delta of 0.6, as I mentioned before. And what we're going to do is we're going to recognize the fact that the call covers 100 shares of stock. In other words, the multiplier for the call option is 100. So instead of calling or referring to the delta as 0.2, we're going to, 0.6, we're going to multiply that 0.6 by 100, and that gives us 60. And we're going to refer to this as a 60 delta call. Okay? Don't forget, deltas are between 0 and 1, exclusive for calls. We're doing this to reflect the fact that the call option contract has a multiplier of 100, so we're going to call it a 60 delta call. And in this case, if we just have one of them, then the delta of our position would be 60. But let's assume we have 10 of them. Let's just pretend we have the number of these calls that we have, and is 10. Okay, let's say 10. And by the way, we're writing them so we're short 10. Be very clear about that. We're short 10. Don't ever forget that. Very important. Deserves a star. We're short them. Okay, and that means my position delta. Okay, my position delta. That means my position delta is going to be negative 10 times 60, or negative 600. Okay, my position delta is negative 600. In determining a portfolio delta, it's very convenient in that position deltas are additive. So if I want to get a portfolio delta, which will be the sum of positions. So here's, I'm going to have one more position here, and then here's going to be my portfolio delta. And if I want that to be 0, then it doesn't take a lot to realize that I need a plus 600 here, right? Well, this gets interesting. I'll ask you a funny question. What is the delta of a share of stock? Well, I'm asking you, what's the change in the stock price associated with the given change in stock price? That's easy. That's like, what's X over X? And the answer is 1. So the delta of a share of stock is 1. And what's interesting here is, unlike calls and puts, the delta of a share of stock never changes. It's always 1. And some argue that that makes it a very good hedging instrument. So since the delta of one share of stock is plus 1, that means if we need a plus 600, we need to have 600 shares. Okay? So if this individual goes long 600 shares of the underlying stock and short 10 60 delta calls, the portfolio delta will be 0. And he or she will be delta neutral. And this means that small changes in stock price will not hurt the investor very much. Okay, but remember, the delta is for infinitesimally small changes in the stock price. And what's infinitesimally small? Well, that's a good question. And let's just say that right now, if the stock price moves up a dime, we expect this call to increase in value by 6 cents. On the other hand, if the stock price falls by a dime, we expect the price of this call to fall by 6 cents. A 60 delta call is 60%. Now I'm just talking about one call. We have, of course, we're short 10 of them here. So keep that in mind. But the idea is you can't count on that 60% because of this. So look, as stock price increases, what happens to delta? Delta increases. As stock price decreases, what happens to delta? Delta decreases. As you can see, this is a positively sloped line. By the way, same is true for puts. It's the same line, just in the fourth quadrant. Okay, so what can we do? Well, we can try to understand that if the stock price rises, okay, let me just erase this. It's absolutely correct. I just want to be able to have something on the screen that I can see here. Okay, so if stock price rises, let's just pretend stock price rises by $1. Okay, just pretend for a second. Stock price rises by $1. Okay, and so my positions are I'm short 10, 60 delta calls. Okay, and I'm long 600 shares. I use SHS to represent shares. And now I'm saying if stock price increases $1, we're gonna forget about the fact that delta is not constant just for a second. If stock price increases $1, what's going to be, so S increases $1. That's the scenario. And we're after the change in the market value of these positions. We're after now the change in the market value of these positions. Okay? And so, well, the 600 shares, the stock price goes up $1, I'm going to make $600. If we pretend just for a moment that the delta of 60 for the call is constant, which it's not, we're going to pretend it is, okay, then that means that the change in the market value of my short call position will be 1 times minus 10 times 60, or minus 600. Okay, just like I got the plus 600 by saying here $1 increase multiplied by 600 shares multiplied by an implied delta of 1 is plus 600. Here, the change in the market value is plus 1, the stock price increase, times minus 10, the number of contracts I have, times plus 60, so minus 600. So you might think that, hey, the market value wouldn't change. But this isn't the case, because what happens is that, again, this is what's happening here. As stock price increases, delta rises. So let's just pretend for a moment that delta rises from 0.6 to 0.7, okay? From 0.6 to 0.7. Now, think about this for a second. If delta started at 0.6 and ended at 0.7, the sensitivity of stock price to a change, the sensitivity of call price to a change in stock price on average was about 0.65 on average, right? So think about that. On average, it was about 0.65. Go back here, and it's rising. So maybe there's all the circumstances for a $1 increase. Okay, and so on average, it was 0.65. So if that's the case, then that means that my delta was really, on average, 65, and that the change in my market value was really minus 650. And instead of being break even, I really lost $50. Okay? I really lost $50 in value as a consequence of the stock price rising $1. Very interesting. Now, if you want to continue hedging going forward, now your delta is 70. So, looking at where you are now at the end of the period during which stock price rose $1, you're short 10, 70 delta calls, and you're at the current moment only long 600 shares. Here is a minus 700. Here's plus 600. Your delta, your portfolio delta for the two positions in your portfolio is minus 100. If you want to get back to delta neutral, what do you have to do? Well, you have to buy 100 additional shares. And if you do that, then going forward, you'll be delta neutral again. I'm not saying you should or shouldn't. I'm saying that's what happens. Excuse me. Now, let's look at something else. Let's look at what happens if stock price falls by $1. Okay? And just like we did before, we're going to assume initially that delta is constant at 60. Stock price falls by $1. My 600 shares will each lose $1, and I have 600 of them, so I will lose $600. And stock price is falling. It's going to help me because I have minus 1 times minus 10, which is plus 10, times 60, which is 600. So you might think that if delta was constant, you'd be okay. But again, the problem is delta isn't constant. Okay? And go up here again and remind you that this red line is the sigmoidal shape that describes the behavior of call deltas as a function of stock price. And as stock price falls, you can see the value here, stock price falling, the value of delta for the call is falling. So let's just pretend that at the end of the period, after stock price falls by $1, maybe it took 3 minutes or whatever. At the end of that period, let's just say your delta is 50. Yeah, that means on average it was 55, so you can see how this story is going to go again, right? It was 55. So instead of that, you have a 55 delta call in reality. So, you still lost 600 on your shares, but you have minus 1 times minus 10 is plus 10 times 55 is 550. So plus 550. And so you lost $50 again. Now this is important to realize. Listen to this. So we're dealing with short calls, and we see that whether stock price rises or falls, when we're hedging with stock, movement in stock price causes market value to, for our portfolio to decrease no matter what. However, you have to keep in mind that offsetting this is a theta-related benefit. That being that since we are short calls, as time passes away, we benefit because of time decay. Ceteris paribus, all else equal, as time ticks away, the value of options falls. So while we're getting kind of hammered with respect to delta, so we're getting hurt with respect to delta, the change in stock price, hurting us. Theta, because of time decay, is helping us. So this hurts us, this helps us, and the net impact depends upon the relative impact of delta versus theta. Excuse me. Excuse me. All right, so that's actually very interesting. Now, so we went through this one example pretty well, and what I think you might want to do on your own is to consider what happens with puts. In other words, remember down here is put options, and the line has the same shape. As stock price increases, put delta increases mathematically. As stock price decreases, put delta decreases mathematically. But you'll remember that with put deltas, if this is, say, minus 0.2 and minus 0.7, greater sensitivity is at the minus 0.7. Let me draw another picture here. So just remember that, so here's call delta as a function of stock price. Here's put delta as a function of stock price. And with a call, like here's 0.2, here's 0.7, and this is a higher value mathematically and it indicates more sensitivity of call price to a change in stock price. Okay? Now here's with puts again. Please watch this, very important. Minus 0.2, minus 0.7. And just understand that while minus 0.2 is a bigger number than minus 0.7, the greater sensitivity is here. The greater sensitivity of put price to a change in stock price. Okay, so you got to keep that in mind. Greater sensitivity is down here. Okay, so for a put, it's because negative 0.2 is a bigger number than negative 0.7, so you have technically the smaller number with greater sensitivity. If you took absolute values, that potential source of confusion could disappear, but then that might lead to other sources of confusion in your analysis. So I'd like you to think through this with respect to put options and just work through this type of analysis with puts and see what happens. I'll tell you the result. You'll see the same thing is true when you're short puts. Okay. If stock price rises, when you're short puts and hedged with stock, don't forget, if you're short puts have negative deltas, and if you're short puts because you think they're overpriced because the volatility premium you believe is too high on the put, then you're going to end up with a short position times a negative delta, so it's going to be positive, and so you're going to be hedging with short stock shares. Don't forget that. It's a hint, okay? So when you're short puts and hedged with stock, short stock, okay, if stock price increases, you lose, and if stock price decreases, you lose market value. Market value. Doesn't mean you lose on your bet that your opinion as to what's going to happen to implied volatility won't let you win, but we're talking about the changes in the market value of your portfolio until the big adjustment that you're expecting to does occur, if in fact it ever does. Okay, so you're gonna observe the same result with short puts as you did with short calls. Okay, so what we've looked at before is short calls, and now I'm saying you're going to get the same result. You lose market value whether stock price rises or falls. If you're hedged with stock, in this case you're short, get the same result. Okay, let me just make one thing clear. When you're using, when you're volatility trading, in order for you to be a winner, okay, you have to find a stock who you believe the market has mispriced. Okay, the volatility premium embedded in the time value of the options price is too high. And then, assuming that you can find that, you have to hope, or what you need to have happen so you can win, is that other people will come to agree with you And they won't just, smack you on the back and say, hey, good job, you're really smart, but rather they'll make trades based upon their opinion. And so if they think the call option or a call option is overpriced, they'll sell it too because they think the price will fall. So they'll sell to open and then buy to close later. And it's their selling that drives price down, which will enable you to potentially win. So you really need all that to happen to be successful. Okay, so please think through that. Replay this part of the tape if you're confused on that. Back up the video for a minute or so and replay that if you have to. All right, so I've already told you you'll lose. Now, what you're going to find, but again, I'll make one point, but TV time value is, not time value, time decay is still your friend. Okay, in this case, time decay is still your friend. Okay, so that means even though you're losing because of the quote delta issue, end quote, you've got the theta issue helping you as time ticks away, the value of your puts falling and you're short the put, so that's good for you. Now, I'm also going to suggest that you do an example with a call where you assume that the volatility premium embedded in the call price is lower than it should be, and you think the market will adjust the price so that eventually it's higher solely due to an increase in the volatility premium embedded in the options price by market participants as a result of their behavior in trading. Okay, so you're hoping all that happens, and you think the volatility premium is too low in a call. So what would you do? Well, you would go long call. Maybe you go long 140 delta calls. Okay, you go long 140 delta calls because you think the volatility premium is too low. You think it's going to go higher. Well, here, I'll give you a hint. The delta of your position then, of course, is plus 100 times 40, which is 4,000. When calculating a portfolio delta, your position deltas are additive, so you need to get to zero if you choose to do this type of hedging. Okay, that means you need a minus 4,000. How do you think you get a minus 4,000? Well, obviously, you go short 4,000 shares because the delta of one share of stock is 1, minus 4,000 times the delta of 1 is minus 4,000. And then you got your delta neutral portfolio, okay? So I'll jump to the end here. What you're going to find out is that when you're long calls or long puts for that matter, and you hedge with stock, you will find out that if stock price increases or decreases, you win in terms of market value. Okay, but, and what do you think I'm going to say here? But now, time decay, because you're long the call or long the put, is your enemy. Okay, so this volatility trading is a wonderful way to have you think through the impact of the various factors that impact the value of options, and noting that as stock price changes, if you're hedged when you're volatility trading, if you're hedged with stock, you'll win or lose, but there's always an offsetting impact that relates to theta. And here I'm showing you that if you're long a call or a put because you think the volatility premium embedded in the options time value is lower than it should be, and you think the market will recognize that and bid up the price solely due to an increase in the market's implied volatility, then you're going to win whether stock price rises or falls in terms of market value. But because you're long the call or long the put, time decay is your enemy. As time ticks away, the value of your option is falling. Okay? So think through that. Very interesting. Now, I'm just stopping here, but you could go even deeper into the analysis. I just wanted to introduce you to the complexity of this, but you could go even deeper. I'll just show you real quick. I mentioned earlier, I'll just look at calls for a second. Sigmoidal shape, here's +1, there's 0. And I'll put another call option chart in green. Okay. And the idea is here, okay, that as stock price, as time changes, as time passes away, you are also moving kind of this way. In other words, the delta, this is call delta, the call delta is a function of stock price. You also have that factor working. In other words, we're not, no, please watch this. We're not just walking along, this particular line as stock price changes, because if stock price is changing and it's doing so over time, you're also kind of rotating toward a new curve, that a new call delta is a function of stock price curve. And so that's pretty interesting because it's very complex. So spend some time thinking about this. And that's all I have on volatility trading. And thank you for watching.